Another blowout divergence occurred today between the spot gold price and the CME Group's June COMEX gold futures price. Here's a chart of the two derivative gold prices from earlier today showing another than $50 an ounce discrepancy between them. And here's another version of this data showing the price divergence spiked today to nearly 70 fiat Fed notes per troy ounce difference. Just 2 weeks ago, we presented our channel viewers with this chart illustrating how historic this multiple week ongoing event is. Here is how this latest $70 divergence looks when added to the chart. Essentially, what is happening here is that London over-the-counter spot gold market appears not to be functioning for physical gold bullion settlements. Traders are apparently still running over to the COMEX gold futures market to establish positions in order to likely take physical gold bullion delivery they might have once done in London had those gold markets been functioning as of late. Hello, this is James Anderson with SD Bullion. Shortly I'll show you more details regarding historic changes in COMEX gold warehouse data, driving home the point that perhaps the CME Group's COMEX is now the sole major physical gold bullion exchange operating with legit deliverable gold bullion of size in the Western world. Large spot versus futures price blowouts last happened in this size and scale back when gold and other major precious metals were finishing their mania phases in the late 1970s and early 1980s. While nominally the present day version versus the 1980 versions may look much larger on this chart comparison, if one takes into account the relative percentage differences of gold's underlying more than double nominal value now versus back then, these respective discrepancies are at about the same percentage level. In other words, both the two aforementioned timeframes are 5-decade historic in their similar percentage size and scope, 1980 versus today. Late last week in our video entitled London Gold Pool Failure 2020s, we highlighted how unprecedented the COMEX gold registered versus eligible pile movements were in a 21st century context. Yesterday, the CME Group's COMEX warehouse reports blew out in size by an additional near 5 million ounces in 400-ounce gold bars added, mostly to the eligible pile. See the change reflected on this chart. The recent 9-entity numbered COMEX gold warehouse report has now doubled in size as 400-ounce gold bar subaccounts have made the report not merely 2 times the size, see left versus right, but also 2 times the size in terms of total registered and eligible gold bullion supposedly underlying this fractional reserve futures exchange. By adding 400-ounce good delivery gold bars from London, the COMEX has in effect been able to go from 8.8 million ounces of combined gold reported in warehouses to now over 17 million ounces as reported today, a nearly doubling of the physical gold underlying their exchange, valued currently at around 29 billion in fiat Fed notes at the moment. Basically, just over 528 tons of gold is now underlying the foreign central bank traded CME Group's COMEX gold market, in a world of about 200,000 tons of physical gold bullion, of which about 1/5 resides with private investors and about 1/5 resides with government central banks. The eventual climb to a $2,000 an ounce gold support for the mania phase likely to follow this looks inevitable, especially with the technical setup and infinite fiat currency QE programs that have been globally activated to fight the likely 1/3 of global GDP we'll lose this year. Those who can afford to acquire physical gold bullion in volume are doing so now, and this historic physical gold flow movement is explicit evidence of that statement. Stay safe out there, and stay tuned for more gold and precious metals related videos upcoming. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.